Thank you, everyone. Let us start our webinar. Welcome to our second webinar on the climate finance, climate capital for women-focused MSME. This is the second webinar of the Gender Climate Finance Collective, GCFC. So before jumping into the panel discussion, I'd like to start with the agenda. We have 90 minutes today. First, we start with the framing inputs like house through and introduction of the panelists, and then we have 45 minutes panel discussion, and then we have like plenary Q&A and discussion session. So you can ask questions to panelists, and then finally we wrap up the session with reflection last 10 minutes. Next slide, please. So housekeeping rule, just 3 rules. Please note that this session is being recorded, and please rename yourself with your full name and organization. And thirdly, this webinar, you cannot turn on your mic speaker during this webinar. So if you have any question you want to ask to panelists, please use the chat box. So please drop your question to the panelists in the chat box. So we will pick up your questions during the Q&A session and ask to panelists. So because I think for some of you, Gender and Climate Finance Collective, GCFC, might be new. So this is initiated by UNDP and UNEP, UN Women. Through the joint initiative, we have program Climate Finance Network by UNDP, and we have joint program Empower to Women for Climate Resilient Society, jointly implemented by UN Women and UNEP. So we gathered together and then initiated this GCFC this year. Why? So we recognize that gender commitment nowadays are still strong, but translation into concrete financial system is very big. And we also are aware that development agencies like us solve similar problems, address similar institutional issues, and search for what mechanism works in parallel with enough collaboration and synergies. And we consider that BLM Gender Action Plan can be a good guiding framework. So through GCFC, we aim to ensure that climate finance decisions become more clearer and more consistent. So the GCFC is a regional advisory and peer aligning platform. The UNEP, UNOMA, UNDP are secretarial agencies, and we have 9 members in this GCFC, like NCDDS, a subnational government agency of the Cambodia, and Climate Policy Initiative, ICIMOD, IGES, SEI, and Green Climate Fund, IFC, and the BRAC Bank. So our focus area of this GCFC is climate finance is governed, allocated, accessed properly, and then creating the linkage between the policy commitment with actual financial decision making. And also we like to promote good practices among members and the participants. The focus theme is first policy and planning, and then secondly investment markets. And how we implement this theme and focus is through the peer learning, like organizing webinar like this, and also through the global advocacy. So we publish our documentation based on our discussion or initiative on the resource platform. So we will share the link of our GCFC website so that you can access to the publication documentation through our GCFC. So now, so today's webinar has mainly 4 targets, goals. First, we would like to explain the structural and risk-related factors that limit financing for women-focused MSMEs in both adaptation and green investment. And also, we like to examine how different instruments types address these constraints through specific design feature and operating models of climate finance. And thirdly, we like to assess how eligibility criteria, underwriting standards, pricing, and risk-sharing arrangements influence uptake and portfolio performance of the climate finance. And finally, we like to derive showcase practical, transferable lessons from product design, regulatory support based on live institutional and enterprises cases. Now I'd like to introduce our speakers. We have 4 speakers, distinguished speakers for our panel discussion. We have Anna Manahan. She is a program manager of Microfinance Council of Philippines, and she is responsible for managing the overall implementation of project and activity under MCPI's capacity building program. She has expertise in project management with more than 15 years of experience working with development organizations, NGO, and community-based organizations. And we have Priya Tachari, and she's a co-founder and CEO of Villgro Philippines. Villgro Philippines is an early-stage impact incubator that funds, mentors, and nurtures social entrepreneurs, having supported more than 200 women entrepreneurs across the region, across the South and Southeast Asia. And we have Shana Fatina. She is the founder and CEO of Komodo Water, a social enterprise delivering sustainable solar-powered clean water solutions to remote coastal communities across Nusa Tenggara Timur, Indonesia. Through innovative technologies, she's driving long-term impact on health, livelihoods, and climate resilience. And finally, we have Saido Abdul Momen. He is additional managing director and also the head of SME banking at BRAC Bank, Bangladesh. With over 2 decades of experience in banking, he has been at the forefront of driving innovation, financial inclusion, and SME development and across the South Asia. And finally, all the panel discussion, we have QA, and then we have Karan Choudhury, Regional Specialist Climate Finance Network from UNDP, who gives closing remarks of the webinar. And sorry, I'm Ayako Sakamoto, and so Associate Expert on Climate Finance from UNDP, and I will do a moderator of today's webinar. So now, I'd like to jump into the panel discussion. I'd like to start with the question to Anna. So, from a perspective of the Microfinance Council of Philippines, what guarantees and risk-sharing structures or any other instruments work best for nano and micro enterprises with limited collateral and with higher vulnerability to climate change?
Thank you, Ayako, and thank you, UNEP and UN Women for inviting us to this webinar. So I'm Anna Manahan, the Program Manager at the Microfinance Council of the Philippines Incorporated. So MCPI is a national network of microfinance institutions and support organizations in the country advocating for inclusive, innovative, and climate-responsive solutions to poverty. So we support our microfinance institution members through advocacy, capacity building, and knowledge management for them to respond to the evolving needs and challenges faced by their clients. To answer Ayaka's question, so in the context of Philippine microfinance, guarantee and risk-sharing structures that work best are those that reduce lender risks while ensuring that nano and micro entrepreneurs are not burdened with this traditional collateral. So firstly, we have this government-supported credit guarantee facility managed by the Philippine Guarantee Corporation. They facilitate access to credit guarantee for financial institutions working within the various key sectors like small farmers and fisher folks, MSMEs, and housing borrowers. Credit guarantee coverage is around 50 to 80% of the principal amount. But this is based on specific eligibilities and the standard terms and conditions for each sector. Next, many MFIs have financial products combined with different microinsurances. Some have micro-agri insurance and others have disaster-related risk insurance. Thirdly, and this is important to highlight, and this is the strength of microfinance institutions in the country, the flexible payment or the flexible repayment scheme and risk contingent loan condition actually strengthen risk sharing structure. Example, grace period, loan rescheduling, and cash flow based repayment shift part of the climate risk away from the borrowers. Lastly, since MCPI is one of the implementers of Empower 2 program in the Philippines, together with Villgro Philippines, Priya is in the panel as well, and our partner financial institutions, we are piloting the Catalytic Loss Guarantee Fund for clean energy transition of women entrepreneurs and marginalized groups. So this guarantee fund aims to de-risk the lending of financial institutions to encourage more investments in clean energy transition among MSMEs in the country. So these are some of the uh, guarantee and risk sharing structures already in place and working within the sector.
Thank you, Anna. Very interesting that the sharing the insights around the importance of reducing the risk of the lenders, and then several mechanisms like flexible repayment structure or the guarantee of financial institutions. Now we have the panelists from the BRAC Bank, the lender to the nano micro enterprises. So from the bank perspective, I'd like to ask to Saido, what regulatory support, technical assistance, and financial instruments can work well to provide women-focused MSMEs with access to clean tech and climate-resilient livelihoods?
Thank you, Ayako. Um, I'll just give you a brief about what we do, and then I will answer the question. Like we are a 25-year-old bank, and we started this bank with a specific focus of providing collateral-free financing to cottage, micro, and small businesses. And then our average loan ticket size would be like 20 to 25,000 US dollars at the moment. So, and we prioritize women, obviously, because we look at women as a segment. It's not just for the doing business, because we brand the woman as a Tara, which means in our language the star, and it makes proper business sense because our whole portfolio non-performing loan stands now at around 2.5%, whereas the women financing book, the NPL stands at 1.2. So that makes clear business sense. So coming back to the question of IOCO, our central bank is also very, very focused in terms of like three major things. One is like the woman, first of all, the gender, and second, the climate resilient financing. And overall, they provide lots of supports. Like my previous speaker said about a credit guarantee scheme. Our central bank provides us a specific credit guarantee scheme, not focused for climate finance, but it's mostly focused for the cottage, micro, and small businesses. And the special or most impactful focus that the regulators do for us is the women entrepreneurs refinancing scheme. And there they provide us a very preferential rate wholesale loans. It's not a loan, rather it's a refinancing fund that they give us to give to women enterprises. And then they get interest rate which is very low, at least more than 10% lower than the standard interest rate because of their support. And another new thing they have come up like 2 or 3 years back, now we are getting the results. What they have said, like they are giving back 1% to the bank and 1% to the borrower in terms for women entrepreneurs if they pay regularly. So the loans are of like 12 to 24 months of tenor. So whenever the tenor is finished, now we are getting 1% back, and also the customer is getting 1% back who paid regularly. So these are some of the regulatory interventions or instruments which help us in providing loans to cottage, micro, small businesses and women segment. And for climate, we have a specific that is also comes in this format, which is a refinancing scheme, where for climate resilient financing or green financing, we get interest rate benefits, which we get and we give to our customers or pass it on to the customers. with regards to BRAC Bank, we also do like one more thing that we do. It's not with the regulator, it's with an organization called water.org. There because our southern part of the country is very saline. The water is very saline. So water salinity is a big problem here. So this impact two ways. One is the access to pure drinking water is a problem for the people, and then the second one is because the soil are saline, so the crops that grows in those kind of crops do not grow in those kind of soils. So we have done several financing and several interventions where we actually developed special seeds which will grow in those kind of saline soil. And also another initiative, actually we are providing small loans where water purifying for establishing water purifying plants in those areas, and we are getting also refinancing support from water.org for that. And through that, the water entrepreneurs are generating or creating clean waters for the people in that area. And last but not least, we also do a lot of work partnering our MFIs, because at the very last mile we don't have our access. So to get to those areas, we partner with MFIs. We do wholesale financing to MFIs, and they do on lend to climate resilient farmers, and also in the focus areas that we want to intervene. So I'll stop there, Aiko. Back to you. I think you are on mute, Aiko. We cannot hear you.
Thank you, Said. Yeah, thank you for giving us a very comprehensive overview of from the policy push to the concrete financial product you provide to nano, small, micro, small enterprises. So I have a following up question. Because often the case when you target on those nano, micro, small enterprise, especially women entrepreneurs, I think the data collection reporting is often the kind of challenge, especially to provide a loan when providing loan to the informal sectors. So I'd like to hear from you, like what data and reporting practices support credible tracking of gender and climate outcomes at the portfolio level, according to your experience at BRAC Bank.
Thank you, Aiko. Actually, this, you have rightly said, this is a big problem because you don't get data the lower you go, the access to data is very scarce. And so we have designed a model where we have credit analysts across the country. And our credit analysts have the approval authority and they collect data. And 3 years back, what we have done, we have started capturing these data in a loan origination platform. So now what happens, all those data are captured, and there are certain regulatory things in terms of climate finance. There are certain data we need to collect and provide to the central bank before giving the loan. So what we have done, so we are now collecting all those data through our loan origination platform. The benefit of it is it's not a one-time thing. Once it is in a platform, then the data remains there. So what we can do, so after providing the finance, we can then see whether there are any change in those parameters, which what was there before giving the loan and what are the changes after giving the loan. So this data collection methodology, or the digitized methodology, has helped us a lot in getting the or measuring the real impact, as well as it helps us to provide the reports to the central bank and to the regulators on a timely basis. So I think first of all, this is a big challenge, but the answer lies in technology, so and data. So what I suggest, whoever wants to go and do this kind of financing from the day one, because we weren't digitized from day one, so I know the pain. So we have digitized 3 years back, so now I can see the benefits out of it. So that's from my side.
Thank you. Very, very, very interesting. And it's great that not only tracking the loan disbursement, you also can track the difference before and after the loan disbursement. So I see the policy push, but also the power of digitalization in the bank operation. So now we will come back to you during the Q&A. I have also many follow-up questions, but I'd like to now move to Priya. So I'd like to ask, how can early stage finance and incubation and enterprises support models help women-focused climate innovations and reach bankable scale? And have you observed any challenges in the support of the women-focused climate innovation?
Thank you so much, Ayako, and very excited to be here. And it's been wonderful to hear the comments earlier from Anna and Sayed, which is, really exciting. Very exciting to hear, especially about the, innovative financing structures in Bangladesh. So I think, fundamentally, I think we have to start with the question, why there is this gap, right? Despite, I think, for decades now, in almost every country in the region, we have been talking about the gender financing gap, and there have been innumerable products, at least in name, that have been dedicated to, women and women entrepreneurs. And I think microfinance, for example, definitely is primarily lending to women. So I think we also need to be conscious of where is the gap, right? And most likely the gap is sort of just beyond microfinance, where we are expecting that people can go to institutional finance or capital, but that's not happening. So either the enterprises remain informal or they stagnate because they really can't grow because they don't have the capital. And that's happening. And I think Anna touched on some of these things, which is, of course, collateral, especially for women, is a huge issue because many of the businesses, maybe they don't own the assets. There is asset disparities. I think the big challenge that we see as Villgro Philippines, we work at the early stages where enterprises are still not, they're not profitable or they haven't grown to a large scale, where they can demonstrate a lot of history, whether in terms of revenue or cash flow, as well as, credit history, which they most likely don't have. And that's where the challenge is, honestly. So, and then you layer that with the risk of climate, if they're working or operating in climate, or if they are at the last mile where they are vulnerable to climate risks. And where we are in Southeast Asia, extreme climate events are very, very frequent, almost on a daily basis. So when you, as an investor or a banker, if you're evaluating risk, then it seems highly risky, right? So to your question, there are kind of two pieces. Maybe let me touch on sort of, I would think that there is a pre-investment readiness phase, and then, and then there's a bridge to getting investment ready. For us as an incubator in sort of the pre-investment readiness phase, we do really see the need for sort of catalytic grants, maybe recoverable grants that can really help these enterprises model or maybe do pilots or testing out clean technologies, validating revenue models, and figuring out really what's the pathway to growth. Of course, we do find that there is often, and not a financial literacy gap, but an investments literacy gap is, and I would put that in like three pieces. One is the internal financial systems, where, your bookkeeping, your paperwork, maybe, your financial systems are not in place. And, that often is what the first thing that anybody that you're going to ask money from is going to ask you for your, your audited financials. And a lot of the times that when we say early stage businesses, that's not in place. So there's that piece of investments literacy is like, what do I need to prepare to go and, provide these documents? Then, of course, the information asymmetry of who really is the right or appropriate capital for the type of business that I am running. I think there's a huge misunderstanding around this. And this is why very often entrepreneurs are very frustrated because, they're approaching a variety of investors or banks, financial institutions, and they're not a good match based on either their state sector or the type of financing that they're looking for. So there is that sort of gap of who to go to and who should I go to when, right? And then there is, of course, we do see a gap of then once they do, even if they have some of these pieces, then we do see that at the stage that many of the early stage enterprises are, especially in climate, the financing products are quite rigid and they're not flexible enough for the enterprises to access. So as an incubator, really, we focus on these pieces, which is how can we move them from, sort of this incubation stage into that bankable stage that you were talking about. So we really focus on technical assistance, capacity building around this, both on the business growth side and then, the financial side. And this is really important. And we do feel that, of course, like there's a lot of trainings out there. And in fact, I would say like women entrepreneurs and women in generally, like there's a lot of mentoring, a lot of support, but somehow we're not seeing the transition, right? So then the gap really is in that investment readiness and what we call that investments literacy. We also see that there is some, we published a report a couple of years ago that there is actually a hesitancy as well, given like a lot of bad news in maybe the ecosystems that, a lot of our women entrepreneurs are also a bit concerned about going out there and fundraising. So their preference, according to our data, is that first to borrow informally from friends or family if they have such a luxury of doing that. Or if not, they're kind of stagnating. They're waiting for the government grants and things like that. And so I think we also need to address that sort of mindset gap in being able to build the confidence of women entrepreneurs really to fundraise. And I think the last thing is that there is a perception of the climate risk, I would say. And that really is kind of an ecosystem effort. We do need to have climate metrics, of course, on the entrepreneur side, but on the institution side, without I think we are still in the phase that without maybe incentives, a lot of institutions will not go into financing climate because they fundamentally see it as too risky. So that's kind of the gap that we're seeing, Ayako.
Thank you so much. Very, very interesting. Like from the gap of the why women are struggling to have access to finance, and then also how Villgro is working to fill the gap through the support on the creating the proper financial system and also the changing the mindset around the access to loan finance, and also the right recognition of the climate risk among the entrepreneurs. I also have more questions. So I think your work in Villgro is using some sort of blended finance mechanism from a combination of both private capital and public finance. So I'd like to hear more on what do you think is the role of blending finance to unlock private capital for commercial usage of clean technologies?
Yeah, absolutely. I feel like over the last sort of 5 years, obviously blended finance has been positioned kind of as the silver bullet, right? I do feel like it's really important. I think any sort of catalytic financing is really critical at this moment because we do understand that, there is a huge gap, especially in adaptation financing that is there. And I think in all of our countries in the region, I think this is a huge issue. And very often, because of all the reasons I think all of us as panelists explained, the gaps are quite deep for, women entrepreneurs working in climate or affected by climate to make this transition or build out these models that are climate resilient. We've seen, and I think, as Anna sort of mentioned earlier, so one of the learnings for us as, an intermediary is trying to get these enterprises funded by institutions and impact investors is that the risk, the de-risking mechanisms needs to be on multiple fold. So of course we are doing a lot on the capacity building and, getting them investment ready and getting all the financials ready. But that alone is not enough to mitigate the risk. And so that's where I think the role of blended finance is really critical. So what we are really experimenting with right now is, I think Sayed also mentioned, is really using blended finance and using the guarantee mechanism. Of course, I think in most countries in the region, there are a lot of government guarantees for specific pieces. But what we've found is that while everybody is accessing that to a certain extent, that also is not enough. So hence the need for other catalytic blended facilities. So we are really leveraging the use of a guarantee mechanism in place to guarantee or cover up to a certain percentage of the loans to our entrepreneurs under this program. And we have seen, and it's been a lot of heartache and discussions around working with the institutions of getting that design right. What we have learned is a couple of things. Number one is that without the role of blended finance or this guarantee mechanism, it has been difficult to convince institutions who, of course, have like a set products to actually come into the sector and finance climate, most likely for the first time, right? Because they don't have models in-house that are modeling for the climate risk because there's so much changing. So the catalytic role that the guarantee mechanism is playing is that trying to build a pathway for the financial institutions to come and finance these entrepreneurs, these women entrepreneurs, these innovative climate models. And that once, and our hope is that, and we are seeing the response. Without that guarantee in place, some of the institutions have told us that they will not be able to do this product, for example, right? So the guarantee has really helped us, number one, bring them into investing into these climate entrepreneurs. Number two, actually create flexible financing products, which is really, really critical for women-led businesses. So I think we're at this stage. Now, is it needed forever? Probably not, because guarantees also should not spoil the market. I think we need to be careful about that. But I think we're at this juncture where we do need a bridge. And there's a real opportunity for very innovative blended financing to really unlock this capital at this very critical stage so that institutions can build the product, so that they can experiment, so that they can learn how to actually model for risk. And I think that's really the power that we are seeing with this model.
Very interesting, thank you. So blended finance is definitely needed for de-risking mechanism as a de-risking mechanism. So bringing financial institution in for the climate finance with a certain sector and creating the flexible financing mechanism, which Anna also mentioned is the kind of binding constraint from entrepreneurs. And thank you so much. Now I'd like to hear from Shanna. From Komodo Water. So you're an entrepreneur, founder of the climate tech companies in Indonesia. So I'd like to hear, as an entrepreneur, what challenges did you face to grow your climate tech business?
Okay. Thank you, everyone. Good afternoon. So I'm going to share my perspective as a woman entrepreneur in the climate tech space. Through my experience with one of my businesses, Komodo Water. So Komodo is working with the water and environment sector for over 15 years and focusing on innovative solutions to improve water access, sanitation, and climate resilience. We aim to create sustainable impact while building a viable business model that address real environment challenges. For the last 15 years, we have seen the changes in the climate finance. Actually, it has been grown tremendously, but it also has been a journey with many challenges. So for the first point that we want to put out about the challenges as a climate tech entrepreneur. So actually, in the early days, climate finance was very, very limited. As already mentioned with the previous speakers, that actually traditional financing is dominated from friends, family, or angel investor, and most investors are focused only for profit, unfortunately, at the moment, and the climate impact was often treated only as a side note or even only as a marketing gimmick. So at that time, the main financial support that we can access were small grants and usually enough for pilot projects. And these grants are often paired with incubators or accelerators, which provided mentorship and guidance. It's helpful, but of course, it's still limited in scale. And I also experienced that the incubators and the accelerator itself, they're also learning to identify what is exactly the new business that's being built by the founders. So even with this support, we faced several challenges. For example, the first one, the access to capital was very difficult. Raising funds to scale beyond pilot projects was not easy, as many investors were really looking for the perceived risks and long timelines already mentioned before. And the second one is to fitting the right funding for the right use was a big challenge. Like this is where the blended finance come in. Already mentioned, of course, with the previous speakers also that in Komodo Water, for example, we use like these grants for research, product development, or testing new sites. And when we already approve and have this proven business model, we use this short-term debt for working capital and then long-term financing for the revenue streams. The third one about equity is quite challenging also for climate business because the returns are often long-term, market are spread between massive and niche opportunities, and it's kind of like very regulated because it's deal with the government policy usually. So not every business model fits the traditional venture capital approach. For this reason, we look for a passion capital models where investors are willing to wait longer for returns. The fourth, ecosystem support is essential, like mentorship, networks, partnerships, and help us really to navigate the market. And it's really interesting because in the climate change sector, it's really different in one region and in another. So when I was gathering with like Southeast Asia entrepreneurs, for example, it's totally different when we discuss with another five region in the globe, like the Middle East, in Africa, and etc. But it's really enriched us to know like the climate change is really different challenge in different areas. The fifth is the regulatory hurdles that require attention. So, like I said before, climate is really a highly regulated sector. Actually, understanding and complying this with the climate-related policy is really important to secure the funding and operate successfully and sustainably. So at this stage, however, there's an often gap in available funding, and I think the current instruments are not always suitable for us that aiming for like social unicorn as SIDBI unicorns, for example. So the issues first, we have this like a toxic valuation game. Like investors often expect like hyper growth, which is not possible and unsustainable for the long term, especially in a climate impact sector. And then the second one, systemic and inevitable fundraising cycles, like we are lack of like a secondary market, for example, for fundraising. So this continuous rounds of fundraising sometimes, and I think it will distract us from the operational growth and also get the third point, which is the mission drift risk. So when equity dilution can pressure the company to shift focus away from its core mission, it's becoming kind of like an awareness for us also for social enterprises. How do you want to deal with this? So the fourth one is the high interest rates for unsecured debt. So like 25% is very high. Like what we able to like do in the in nowadays is around 10 to 12%, but that's why we really picky in picking which debt or loan that we're going to use for our business. And last but not least, the insufficient historical track record that many social unicorns can't access conventional debt because we're really at the early stage or lack long-term financial history. But of course, over this last 5 years, everything has been improved, including the venture capitals and innovative instruments. But of course, the challenge is how to matching the right funding to the right purpose, to the right business. And for us, we always take a look at the long-term equity, long-term benefit for both sides between us and also the investors.
Okay. Thank you so much, Jana. Very comprehensive overview of challenges you have said faced through the like both debt, equity, access, and then also the overcoming regulatory hurdles. And now, through all those the hurdles, barriers, I am very impressed by how Komodo Water has been done so far, and I would like to hear more from the perspective of the entrepreneur. Which, for example, additional financing terms or processes or support might be most helpful to have access to climate finance, both debt, equity, in practice?
So for us, accessing the fund is not just about the money, but actually having flexible structure, practical support, and networks that allow our business to grow sustainably. So, for example, the flexible financing terms, like this climate tech project often take longer time to generate returns, correct? So that's why the financing scheme has to accommodate this. So the timelines, the passion capital is really essential. The second one, how to simplify the process. So the complex application or reporting requirements, because like a lot of measurement from financial measurement, also impact measurement, sometimes will discourage the early stage founders, which like they have a good idea, especially for women's. So the clear and straightforward process actually help the founders to focus on scaling impact stage by stage, because they cannot uh, like have this one silver bullet to solve everything, all the problems that they see in their field, basically. So it's not just a completing a paperwork. The third one, how this supporting and the capacity building is very important for us, especially the guidance on business planning, financial modeling. Sometimes people just these entrepreneurs only want to solve the climate issue, correct? And then they don't know like how to build as a business, how to make a financial modeling, and how to report and etc. So this technical assistant, I think, is really important to support these new founders or women founders who sometimes face the barriers in investor communication and technical credibility that they cannot use the right words to explain to their investors. And then last but not least, the ecosystem access. So networks, mentorship, connection, groups, investor, industry, it's really important because when we build like this climate tech, so it has to be not only one, but it has to be a lot of people playing in the same field. So then it will de-risk the risk, which is like investor will be very comfortable with to invest, because not only one product or one company, but they have a lot of companies doing the same thing and building the ecosystem that will sustain their work.
Thank you so much. Very interesting. So I think some of the suggestions might have been like already provided, for example, by Villgro credit guarantee. And I understand as a development agency, like how important it is to create the ecosystem network, not just exchange of knowledge, but also the matching the startups to have a similar business so that we can negotiate as a group to a financial institution for better terms for investors. And needs of the flexible loan conditions, and then maybe the impact investor who can embrace a longer term return, and also the need of capacity building, including the financial modeling or the pitching to investors and the banks with a specific wording requirement. So thank you so much. I think we still have time, allocated time for panel discussion, but I have seen so many questions from the audience. So I think it would be nice to now move to questions from the audience. Because our team has selected questions to panelists. So let me start the questions one by one. First question is to Anna and maybe Priya, but can you tell us more about the credit guarantee schemes and how beneficial they are for risk management? Yeah, so it would be appreciated if the panelists from Bangladesh and Philippines could distinguish how the credit guarantee schemes in their country differ. So I'd like to start with maybe Anna, and then we'll go to Said.
Yeah. So the credit guarantee scheme in the Philippines under the Philippine Guarantee Corporation. So they actually look at different, they have priority sectors. So this is in the agriculture, the MSMEs, and the housing borrowers. So because these are, most this sector, face the most risk in terms of climate as well as disaster. So there are different eligibilities and different design for each of the key sectors. So for instance, for the agri sector, they have a coverage maximum of 80% of the principal amount. But of course, there are certain conditions where you need to meet for the financial institutions to meet. So and also, financial institutions need to be enrolled in the credit guarantee facility for them to access the fund. So that's how the Philippine Guarantee works in the Philippines. So these are open to microfinance NGOs, cooperatives, banks, and other financial institutions, regulated financial institutions, of course. So I'll let Priya discuss more on the catalytic loss guarantee fund, since we are piloting this with them with our partner financial institution under Empower.
Great, thank you.
Sure, I can jump in quickly.
Okay,
maybe.
thank you.
Just to explain. So, I think Anna gave a great sort of overview of what's in place, in the regulatory framework and what's available from the central government. But I think for us, like on the project that we are working on, the UNEP Empower program, we are quite early in the process. So we're just issuing like our first guarantee letter, etc. But just to give you a sense, we have sort of multiple models. So like any guarantee, what we are really offering is instead of collateral, we are recommending that, we will provide a guarantee if there is a default. But there are some guidelines around it. We, of course, in good faith that the institution is following its due process, if there's opportunity to restructure, etc., because they know they're monitoring the company as well. All of those processes need to be followed. But in the event there is, for whatever reason, a default, then we will pay the balance, right? A percentage of the balance outstanding. So we've sort of very interestingly designed a couple of pieces. One, I think the innovative design really is for one of the institutions, and this is like, in our earlier pilot before UNEP as well, what we designed is a sliding scale. So we provide, say 50% to 15% on a sliding scale of the guarantee. So at the start of the tenure of the loan, we start at 50% because the underlying assumption is that, they've just gotten to know the enterprise, the first time investing in this. So, we are still perceiving that they don't have the relationship based, to kind of restructure, etc. So we start at 50%, and as the tenure of the loan progresses, the rate kind of slides down, and we guarantee a minimum of 15%. So this is sort of designed, along with the institutions that were involved. And I think this has allowed us also not to be locked in, because we don't have a very large guarantee like a government guarantee. So it allows us also to free up capital to support additional enterprises, while also putting in place incentives for the institution to feel a bit more confident about this particular lead. In other cases, we've done sort of a flat rate, which then means that the institution is evaluating is that they have the government guarantee, and then on top of that, they have this. So they feel like fairly solid about, the risk or something completely new that they're investing in. So really the role of that guarantee mechanism is not to encourage default or not to encourage, behavior where, you're not evaluating risk. I think we do ensure that, it's a collaborative effort, and, especially in models like this, where we're all here, for example, in this case, to fund or just transition or clean tech, where we are trying to develop and experiment with instruments. So this instruments, for example, like an early stage enterprise will never be able to get a credit line from an institution. But for example, in some of the previous loans that we've done under the guarantee, that they were able to get a credit line. So usually credit line is only available like if you have a very long established relationship with the bank, or you have very high, revenues that, people can see. So the fact that we are able to unlock these type of instruments for very early stage, perceived as risky businesses, I think that's what the catalytic role of this capital is.
Thank you, Priya. I have just quick, very follow-up question on guarantee. So, of course, we don't assume that we don't hope to have a default, but I think when setting up the guarantee mechanism, you have some sort of benchmark assumption of how much risk could be materialized, and how much kind of risk did you assume, either from this going guarantee scheme, or maybe from the market average or insights in Philippines?
And I'm not sure if you have like some metrics about the market, but of course, like we are also looking at like a portfolio risk So in sort of modeling for the whole guarantee, we are assuming that, okay, say if there are just a very rough high level numbers, if you're doing sort of 10 deals that we do expect, maybe like a 10% risk. But because I think fundamentally it's also like all of this is also fairly trust-based relationships. We are believing that the institution will also follow its best practices, right? And they are legally bound to follow, restructure, build a relationship with the enterprise. And maybe society can have some perspectives on this of how, even if something goes wrong along the way, there are ways that we manage that risk. So there is that good faith aspect, for us as a guarantor. So that's why we're also selective on who are the institutions that we are working with as a very small guarantee.
Okay.
Maybe
Thank you.
society will have more
Actually,
insights on this.
Actually,
Thank
Priya
you.
rightly explained the guarantee scheme, how it works. From my experience, what I can say, like normally financial institutions shy away from many sectors, like especially where they don't get collateral. As I said, like southern part of Bangladesh, saline water, their agri sector, banks will not finance. But to make the bank finance in those sectors. So that is where the credit guarantee instrument plays the role. So this gives the banks or financial institution the additional comfort, like, yes, I can take that risk. I will take that risk. Because if the loans go bad, then I have this support mechanism, which is the credit guarantee scheme. So that is what allures us to go into this credit guarantee scheme. So that is very easy to say, but the implementation part takes a bit of time because the guarantee provider uh, looks at a lot of things, like Priya said. See, because they look at the organization first, and then there are a lot of things, lot of nitty-gritties which needs to be figured out, like when the guarantee can be claimed, how much can be claimed, how much percentage of portfolio will be guaranteed. So those are many nitty-gritties when you design a guarantee scheme or finally come to an agreement on a guarantee scheme. And there are fees on both sides. There are fees from the part of the bank or financial institutions who is engaging in the guarantee scheme. Also, in our case, our central bank has allowed the even us to charge the customers the guarantee fee. So that is also allowed. So here there is, as Priya said, which actually kicked in my mind as when we first started this. So then our sales team said that, okay, if the customer know that their loan is guaranteed, they will not pay. Why will they pay? Because they know that if they don't pay, someone else will pay for them. But actually, what we have seen, this is a mindset, to be very honest, because the customers whom we finance, they don't take the finance to default. They take the finance to grow their business. The default happens in a very, like, in our case, the guarantee scheme default in one time we had is because of the flooding. There's nothing in our hand. So I think that is a mindset, because the financiers are always very, very conservative when it comes to financing the enterprises. I think you have to actually judge the enterprise or entrepreneur more while financing, or his or her intent, rather than whether, if you focus on if you at the very beginning, if you think that he will or she will default, then you will never be able to finance them. So I think that's my 2 cents on the credit guarantee scheme.
Yeah, if I may add with Sayed, I agree because there are different realities of the different sectors. So in the case of the Philippines, where agriculture is still a main sector, there is a relatively low uptake on small or financing of micro agri loans. So it makes sense that there is this credit guarantee scheme or fund for smallholder farmers and fisher folks. And with the sustainability or sustainable finance framework in the Philippines within the financial sector, I think it reinforces how credit guarantee scheme should be designed. And climate finance should intentionally be designed with the different realities of the different sectors because, different sectors faces varying risk as well. So credit guarantee mechanism is important to intentionally be designed within those realities.
Can also jump on this issue. It's actually, I mean, as an entrepreneur, sometimes like the women in the field, they're not aware and they're not familiar with these words, like the financing words. So sometimes when the financing or investors say to them like some terminology related to the financing, they just pull out because I don't understand and I don't want to take like more risk than I can understand. So I think not only about how the mechanism, they always want to grow, but they also have to learn something new, like facilitating them to know like why you use this financing, why the other scheme is very important. So then the financing facilities that being there and being designed can be used by them also. So it's really important.
Okay. No, thank you all. I really love this whole discussion and the different view from different countries. So I think audience enjoyed the discussion as well, and we have also many more questions. So I would like to ask next question. So do you think it is enough to target cottage, micro, small industries to equitably benefit women? Or do we need target schemes to serve women micro enterprises? I don't know anyone who can feel comfortable to answer this. So I repeat the question. Do you think it is enough to target cottage, micro, small industries to equitably benefit women? Or do we need target schemes to serve women micro entrepreneurs? So I think individual, I asked it. Yeah.
Yeah, I will answer that because we do a lot of those. See, because we are an Islamic country, so in our social demography or in the social debut, it's very hard for a female to come out of the home and become an entrepreneur. So so what we see, if someone comes that far, a woman doing something, so we consider that as a big thing. And then we look at the business and then we do provide financing. But uh, what I think, if you want to sustain it, because for this type of woman entrepreneurs, specifically in the cottage, micro, and small, in these three segments, their problem, finance is one of their problem, not the only problem. Because in most of the cases, they start the business from a fund from either from their father, from their husband, or many cases from their own savings. But they need lot more support in terms of getting the business entity registered, getting the related licenses done, then knowing how to manage the financial of the business, then how to present your financial to the banks or financial institutions to get finance. So these are certain areas where you need to intervene if you want to do financing in a sustainable manner. So that's what we do, because we are not for the short run, like we are not for like one finance, collect repayments and then go. So we are there for the long haul, and we are partner to the journey of that entrepreneur's growth. And I think if we do it that way, other than this path, you cannot make an impact, because then you can just do a finance and you go out, and then she is left alone with any sort of access to finance. So this will, so it's have to be an integrated approach, and which have to be sustainable, and these areas needs to be covered. Finance is, we just always think that finance is the only problem, but this is not. Finance is one of their many problems. Then another big problem is access to market, because that small entrepreneur, she whatever she creates, she sells only in her society. But the market is huge. There is a lot of big access to market there. So we help them so that her sales grows. So these, I think, is have to be an integrated approach, and you have to have the intent of making an impact rather than just doing finance.
Yeah, I just want to jump in. I think that last point is really important. And many times, like, I think this is something that is missed. We also see that, especially in the Philippines, that a lot of the micro entrepreneurs, who are not in the big cities, they're only selling, they probably have, they've set up a mushroom facility, they're selling like whatever, they're creating chips, powders, whatever, but they're only selling in their town or village. And that is a very low purchasing power. But most likely, like, there are many barriers to get into the next city even, which is that they need FDA or equivalent in different countries, right? And mostly they don't have the money for that, or there's no local facility available which is FDA approved. So there are a lot, and that's one of the barriers. There are many, but this is something that we see very, very commonly, that most of the sales is very local, hyper local, and then that gets saturated very quickly. And the minute that they need to go anywhere outside, either it's certification or they need volume, or they just don't even know like how to access that market. So I think there is a multitude of issues. And this is one of the other reasons why we are not seeing a lot of enterprises graduate from nano to micro or micro to small. They sort of remain where they are, which is okay. In most cases, maybe people don't want to grow, but there'll definitely be a percentage of women who want to grow their businesses, but then they're unable to because of this issue.
And Priya, just follow-up question. Do you think the capacity building support is needed for both sides, not only to the entrepreneur, but also financiers need more sensitization on where to invest and why for climate-related causes?
That's a great question. I am a fundamental believer in that because I think we overemphasize, of course, because there are a lot of gaps, and that's the volume, the pipeline. But we also, of course, need, I would say, educating is one thing, but also really just expanding and just bringing more of what's happening in these sectors to the financial institutions. We have done multiple trainings around sort of investments in climate, investments in certain impact sectors. Because one is that a lot of institutions and impact investors, or those who are trying to get into the space, angel investors, it's very hard for them to evaluate businesses in these sectors. So how do you do diligence, right? Most likely it'll be quite expensive because the entrepreneur is quite far away. They're not in the city. So cost of diligence is quite high, which itself will put everybody away. Even if they're very well-intentioned, models of like, how do you evaluate risk, especially for climate vulnerable enterprises, really don't exist. So I think this is still an emerging field. And so we've found a lot of value, and we spend a lot of time not only capacitating the entrepreneurs, but also really working with the institutions, either to create some of these financial products specifically for a sector or a particular value chain, bringing new ideas of flexible financing instruments. So whether we're doing revenue-based instruments, impact-linked instruments, blending sort of instruments. And I think I would say a lot of institutions are quite open to learning about these, but I think finding out about it and then implementing it is like a big leap, right? Because there's so many people, the board needs to approve, you need to change your system, which costs money. So I think it's important for us to be in a phase where we are piloting with many institutions until they can see the value and they can develop the systems to do it. So where it's not as straightforward as like, okay, there is climate, we have to invest, or we have to put in place mechanisms, one of which is, of course, capacitating the institutions, but also pathways of how do we implement, what does that change management mean inside the financial institutions. And sometimes, we're all just scratching the surface, and there's a lot of very intentional discussions. And that's where we're not seeing the implementation, because a lot of it costs money, and it's a lot of effort for an institution to create a new product with something changing in the pipeline building, something changing in the design of the instrument, something changing in, how are they going to monitor it, how are they collecting the data. And I think that's where, where like somehow, I'm sure all of us have been in like 20 panels about this already. And this is why it's not happening as fast as we want it to.
Yeah, just to add to Pia's input, I think institutional buy-in for you to be able to really implement this kind of initiative, not just from the management itself, but also with the people working on the ground. Because if they don't understand the risks of the institution as well as the risk of their clients within, the climate, space, it's really difficult to mainstream this kind of climate finance. And if you don't understand the realities of the different clients you're engaged with, it's really difficult to create new products that would actually address those realities. So yeah.
Okay, so, very interesting. Yeah, so maybe not only to the entrepreneur, but also maybe also as a development agency, we should also work with the financial institution to provide give a good proper perspective of the climate change risk, but also the risk of entrepreneur. But it's actually in fact lower than usual, but they haven't done it before, so maybe risk perception might be higher than actual it is. So I think you mentioned briefly about the data collection difficulties. I'd like to hear more from Said, because BRAC Bank already set up some data collection loan disbursement platform. And we received a question from audience like, what suggestion you have about selecting parameters in data scarce environment and where digitization is starting in the financial institutions?
So see, in like data, AI, this is the future. We all of us know, but AI, will not work without data. So you have to have data if you want to design AI or anything. In an environment like ours, where the government sector data, or you call it DPI infrastructure, the digital public infrastructure, in our country, it's very poor, very nascent, very basic. All we have is a national ID database. That's all. It's not like India or Singapore. So in this kind of environment, designing something based on data is very difficult. So what we have done as a workaround, we are been financing SMEs for last 25 years. So whatever data we have, we are working on that, designing models on that. And we are slowly opening the fence, because over last 3 to 5 years, many of the fintechs have come in. Fintech, agritech, insurtech. So these like insurtech providing insurance, then agritech doing interventions between the farmers and financing and providing various sort of support, and then fintech providing integrating solutions between the financial institutions and the entrepreneurs. So what we do, collaborate a lot with them. And like we also own the biggest financial MFS, which is the bKash. So we also partner with bKash in terms of, because have a biggest payment platform in Bangladesh, and they have grown a big merchant network where they take payments. So what we do now, we are integrating with bKash data, and then we are applying our credit lens on those data and providing financing to the enterprises or the merchants of bKash digitally, seamlessly. So no more hassles, nothing. All the data is collected digitally, and they upload their licensing or registration related documents. And some of them they do have with bKash shares those with us. So these are kind of a partnership example which we are doing. And also we are partnering with, say, Unilevers and Nestle's, and getting access to their ERPs, and through the registered sales of their retailers, we are providing finance. So these are sort of innovations that you have to do in an environment where the data is not there. So you have to do a lot of partnerships, to summarize, because there are data available. You need to like search for those, because the government will only provide very little. And then the second would be like, once you get a partner, then you have to have a credit team who is flexible enough, or rather, I would say, forward thinking enough, who are ready to take call on those partners' data. So what we do, we don't only rely on partner data, we do some sort of triangulation. Like, we take other data and matched it with other data and verify, and then take a call. So these are certain things I think we should think about before like using data to provide financing in an environment like ours, which you define as data scarce.
No, thank you so much. It's very interesting. I think some questions about the related to data collection. So when you collected, assume to all the panelists potentially. So because the climate change risk is not necessarily factoring in the regular practice, I think the 5 bands. But when you do, or when you do incorporate such risk, what climate risk are normally factored or as a first step, and how they tackle the issue of scale from nano, micro to bigger enterprises, especially for the climate enterprises. Maybe I can start with Side, because you already have collected some data around the climate risk, but also maybe Priya, please jump in.
Yeah, actually, for climate related data, like, we are financiers, we are not climate experts. So what we have learned, that the central bank has played or the regulator, they have played a vital role, because they have given us the framework. Like, because as I said earlier, that we do have a like refinancing facility for green and climate finance. But if you want to get access to those green or refinancing facility, there is a framework. You have to collect a lot of data. So those are all climate specific data. So what we do now, because there is also certain benefit that the regulators give us for on the portfolio side. So in order to make most of our portfolio green, because see, before this all climate finance and green finance thing came out, we started finance 25 years back. So we do have already, without knowing, finance some green projects, but we don't know. So what we have done, so out of these frameworks, what we now do, actually, we look at, now we have adapted this framework in our standard credit process, so that whether it's green or not, we collect all those data. And by doing that, we now know how much of our total portfolio is green. But I would say the framework was given by the regulator, and because the regulator is also signed some agreement as a country to provide certain green initiative or climate change initiatives, and based on that, this framework came into us, and then which we started using it. So this is how we do it.
Interesting. So they basically, the regulator also give a guidance on which climate factor should be incorporated in the financial product. I would like to hear if that's the case, also Philippines or Indonesia, or if you have any view on that. Also, Priya, when you interact with the banks developing the guarantee mechanism, I think you also might have discussed on that kind of thing. So, yeah.
Yeah. Maybe Anna, do you have something on the regulatory stuff? Maybe you are better placed to answer than I.
Well, as mentioned by Sayed, financial institutions are financial expert, no, developing loan products, etc. So it's really important how climate risk are assessed at the level of the institution. So a regulatory framework in terms of what are the different elements to look at when you're assessing climate risks within, entrepreneurial, space. And I think that also within the regulation of the sustainability framework or sustainable finance. When you provide sustainable financing for your clients, what are the different risks, climate risks that you need to look at. So, and that should cover how climate, risks are integrated in assessment. May it be like, the weekly payment or bullet payment scheme. So because this is already being practiced by microfinance institutions, there's a need to like integrate how climate risks are being looked at in a enterprise where they earn in a weekly basis. Is there are there risks that they face in a weekly basis or in a month or etc. But in the case of the Philippines, I think the number one, climate risk that they're looking at if they are, flood hazard, the heat, for farmers, especially working, engaged in agriculture, El Nino, La Nina. These are, the climate hazards that the microfinance institutions are looking at because they also design the loan product in such a way that it reduces somehow the burden to the clients when they repay the loans. So those are like the well-known climate risks or hazards that microfinance institutions are looking at.
Yeah, I would say that it's very nascent, Ayako. I do think that, of course, like as Anna referred to earlier, and most countries in the ASEAN region, the central banks have come out with sustainable finance frameworks, but it is quite broad yet. And I think the rules, especially here in the Philippines, is just being developed. I think this is a new framework just from the last few years. Implementation and adherence to that framework itself, is not yet in place, simply because of this issue, because the criteria, data points, the frameworks are not yet in place. And I think institutions also developing it. I think we are definitely at the stage where people looking at the portfolio and very high level recategorizing it to make it sustainable. We're at that phase, right? Which is a bit of greenwashing. I think the next phase, which will take us a bit long to get there, is actually building the systems, at the grassroots level, at the loan officer level, to integrate these climate metrics. I would say, honestly, we are quite far away from it. Right now, it is what Anna was mentioning. We are assessing on very high level, practicalities of climate risk, like depending on where the enterprise is located, flood risk, typhoon risk, whether they will actually be able to get a shipment out if there's a weather event and things like that. So which is still on a case-by-case basis. So for us to see that cumulative effect on an ecosystem, like in the financing system, I think we are quite far away from it, because these kind of things are still being developed, because the reality is also changing, right? Like the number of storms we are getting in a year has significantly changed from like even 4 years ago. The frequency of flooding has increased. So I think a lot of things are changing as well. And obviously the metrics, etc., haven't kept up. So we are still at quite a high level, and we are still at the risk of, honestly, a lot of greenwashing, I would say. But from a practical point of view, I think there are frameworks that are being developed. For example, I think it's also different for types of institutions, right? I think like a bank is looking at large numbers of loan. As an impact investor, we are looking at small numbers of loan. So we are able to do one-on-one, case by case, looking at climate risk of a particular industry. So we need different type of metrics versus a banking institution. So I think we are still quite early, is what I would say. Having said that, it is impossible today to not analyze the climate risk, because, in a country, for example, like the Philippines or even Indonesia, because we are affected quite frequently. And so it is being evaluated, even if it's not formally looked at as a climate metric, but it is being assessed on the ability of the enterprise to deliver what they have to.
Okay, very interesting actually. So maybe it could be useful to have a guidance from the government, the central bank, to the financial institution or microfinance institution. Maybe we'll also have a useful tools to assess the climate risk at the institutional level. Maybe in 5-10 years and maybe more recent, we could have moved to the next stage. The loan officer also is aware of how to integrate the climate risk into their assessment. So we are almost running out of time. I'd like to make a last question. So we have Eleni from GCF. GCF is one of the member organization of our collective GCFC. So we have the question from her. So first, thanks to all the panelists for their thoughtful contribution. I will be curious to hear more from them, on the degree of demand they see in their portfolio or at the national level from women entrepreneurs for climate-related MSME finance. The emphasis being on climate-related, obviously, if data is available. And we heard there is tracking of this in Bangladesh, from Said, as well as transition-related finance needs. As we are at the Green Climate Fund, gearing up for the finalization of our gender action plan, we very much welcome signals from the ecosystem on the demand and how this play out across different segments and products. Anyone who can jump on if you have any observation. So let me quickly repeat the question. So she'd like to hear on the degree of demand you see in their portfolio or at the national level from women entrepreneurs for climate-related MSME finance, the emphasis being on the climate-related.
Maybe Shana will also be able to jump in on this. I really don't think that many women entrepreneurs are seeking out climate financing, or I don't know any entrepreneur, to be honest. They are seeking out financing. Now, if this product sounds like it will fit them, then they will go for this. If this product, whether it's climate or not, sounds like it would fit them, they would go for it, I would say. I think there's only a very subset of enterprises that maybe are in clean technology specifically, who can be part of large infrastructure projects or large climate financing projects, are probably the only subset of people who are very actively seeking out climate finance. For most micro and small enterprises, I don't think we are at the maturity of the ecosystems where people are seeking out climate products. I think they're not getting financing only, forget if it is climate or something else. I think so they're just worried about, can I get some working capital? Can I get something else, right? Can I get a short-term loan? How can I get a collateral-free loan? I think we are still at the absolute basics, and this is my sense. And I would say there'll be just slightly varying degrees across all of our countries. So, but having said that, when they are assessed, then they will be assessed for all these risks. So I think, sometimes it's a taxonomy issue, but I don't think, and I think Shana spoke about this earlier, when people are not able to understand the terms and the names and stuff, the people are stepping back, especially women. And that's where, I spoke about the investments literacy gap. One of the big reasons is that they're not able to understand how to navigate the financial ecosystem. What are this terminology? As the more complicated it sounds, actually women entrepreneurs are not actively seeking. They'll try to find some other way. And for those who are maybe at the micro and small stage and who have access to credit cards or are able to borrow informally from people they know, that is their first choice, unfortunately, even today, which ends up being quite expensive or at the risk of, a personal relationship. Because that, borrowing consistently from people is not the right way to grow your business, right? But many times that's preferred. So that's what I would say that we are still at that stage. Climate finance, I think as institutions, as ecosystem builders, it's important. It's a very important role. But when we are deploying the capital, I think we have to simplify, what we are putting out there. That's my perspective. And Shana, maybe you want to jump in on this.
This is very interesting. So, based on our experience, also sometimes when we see financial institution try to support climate financing, their product is not fit with what is needed in the field. So basically, sometimes it's somehow designed for industrial scaling and just a common business. So it doesn't work. So we have experienced a lot of green funding put back in some Indonesian institution, for example, but it's never been used by the users because we cannot comply with the requirements that they need or the business model that they can accept in their mind. So it's quite interesting. So actually there's a need of discussion between what is actually in the fields happening, what is people building their solving their climate problems, and then how it can be accepted in the financial terms, and then what is the risk can be put from that, and then it becoming the base of why this scam can be used for putting the funding down into like downstreaming the and distribute the funding basically. And the accelerators, incubators are the perfect partners, I think, because they are the one who get in touch all the time with the people in the field, and sometimes they become the ambassadors of this climate tech or climate change business to the field, and then when they know, and then they will identify themselves as a climate entrepreneurs, for example. But like Priya said, it's correct. Like sometimes you can find yourself as a climate entrepreneur, sometimes as like a health entrepreneur, as any kind of like segments, as long as it gives you like a good funding to do your project. So to make it like as a massive movement, I think there's a very important translation language between the funding, the big funding, and then the financial institution especially, and how this financial institution has to give more effort for them to learn from the field, to hear from the people who wants to use the money, and how to create new models, because we cannot be lazy. You have to inventing new models to run this business basically, right? So because it's not yet there, so that's why all of us has to work together to describe what is the ecosystem of a climate financing, basically what it has to be done from the entrepreneurs, from the incubators, accelerators, and the financing. At the end, we have, I think the success is when the entrepreneurs, like climate entrepreneurs, can access a traditional bank financing actually, and then the banks able to see and they risk the business in a very objective way, not in the terms like because they don't understand the business. So it's very important.
I just want to acknowledge that Mamta's provided a clarification there on demand from those who are in vulnerable areas, climate vulnerable areas. And maybe I just want to address that because I took it in a different direction. I apologize. I think I think there is still a gap. So which means that there is definitely demand. What I have noticed in our work, for example, in nature-based solutions, which is a lot of very small and micro enterprises in highly climate vulnerable areas, coastal regions, is that we have found that many of those enterprises are still either community-based or very small. And so they are still looking at sort of grant and catalytic type of financing. And they are not yet able to transition into more institutional financing. So there is still that. So there is the need, but the capacity to, and the pathway to getting investment ready, I would say, is still quite low. So we're just wrapping a program with UNDP on supporting nature-based solutions here in the Philippines. And I would say that the program is focused on investment readiness. But at the end of it, the transition to becoming investment ready is quite far, especially in the context of the vulnerabilities in these coastal areas, for example. And we have identified that we're not able to actually move them into formal financing or banks yet. We have to find some alternative financing mechanisms and instruments first that can help catalyze them, help them become more revenue focused, show that they are viable businesses. And that's the kind of, I feel like, it's a similar case that we've seen in some of our portfolio companies in Indonesia as well. Highly climate vulnerable enterprises. So first, we have to make them resilient, but the institutional capital is too far away from where they are from a risk perspective and is not able to fill that gap. So we do need something in between, right? That risk capital, which is a different kind of animal, a different asset class, seeking different type of returns, I think is still needed.
Yeah, thank you so much. I understood that the push both from the financial institution, but also the Accelera program, like development agency, who also provide a technical assistance to make the business more resilient, but also the scalable or profitable, will be both needed to fill out the gap and scale up the enterprises. So we are running out of time, so I'd like to move to the wrap up. Before wrap up, so we will share upload the summary of this webinar and also the answer, because we received so many questions, but we couldn't answer all of them. So we will also upload the answer to some of the questions we haven't answered in our GCFC website. I think our colleague put the link in the Zoom chat already. So I'd like to give the floor to Karan for the closing remarks.
Thanks, Ayako, and thanks everyone. Good morning, good afternoon, good evening. That was an incredibly rich conversation. So I'm just gonna. I know that we are over time, so I'll be fairly quick in my reflections. But I think just to sort of go back to the original sort of concept note and the fundamental premise that brought us together for this discussion, that in the Asia Pacific, between 94 to over 94% of sort of businesses that employ over 2/3 of the labor force are micro enterprises, and women are very highly represented in that segment. And what today's sort of conversation also sort of reinforced for me was that climate finance for women-focused micro, small, and medium enterprises is not really a niche agenda. It's central to adaptation, to livelihoods, to inclusive growth. It's an agenda that brings together all of you as stakeholders at very different parts of the sort of trajectory of an enterprise. And therefore, this webinar today was also designed to move beyond theory to sort of examine product features, risk sharing structures, eligibility criteria, underwriting practices, and some real experiences that each of you have done such a great job sort of bringing to the fore. So maybe just 4 sort of points that stayed with me basis everything that was said so far. One, that risk is perceived, but design is very determinant. So access barriers to finance are often structural. We heard that collateral requirements, underwriting standards, misaligned sort of eligibility criteria, limited data often exclude viable enterprises even before they are perhaps properly assessed in terms of their ability to access finance. The discussion on risk guarantees and risk sharing mechanisms sort of demonstrated that well-designed mechanisms and instruments can sort of expand access without necessarily increasing default risk. I was also sort of listening to the point that our colleague from the BRAC Bank was making there as well, that these loans are being taken on for the purposes of growth. And at least what I was sort of trying to read between the lines was that perhaps the default rate in that segment is actually much lower than some of the more sort of evolved or grown spaces in the economy, that these enterprises actually make for better borrowers in that sense. The second reflection was around the fact that bankability is something that does need to be built. It needs support. Whether it's incubation, whether it's enterprise support, whether it's technical assistance, catalytic capital, that these are not really add-ons, but that these are actually preconditions for scale and preconditions for growth. And UNDP, through the work that we do at the Climate Finance Network, does a lot when it comes to sort of ecosystem support and making sure that that is integrated rather than fragmented, whether it's working on accelerator programs, whether it's supporting the design of guarantee structures, whether it's work on larger sustainable finance frameworks and mechanisms. The third reflection, and then I just have one more, was the point around sort of capacitating all parts of the system. The fact that capacity building and investment literacy, and I think it was Priya who was making that point, is not needed just when it comes to entrepreneurs, but also for angel investors, for parts of larger financial institutions as well, so that understanding and evaluating risk is also something that they are capacitated towards. So they understand how to deal with these enterprises while we also support some of these micro, small, and medium enterprises in terms of how they engage with larger financial institutions. And the fourth point here, and this one around the fact on sort of data and digital infrastructure as enablers as opposed to being afterthoughts. The fact that, one theme that underpins a lot of what was discussed today is data, that if we want guarantees to work, we need portfolio level data. If we want gender responsive lending, we need sort of credible gender disaggregated tracking. If we want climate alignment, we need consistent reporting on sort of adaptation and mitigation outcomes. So digital public infrastructure and digital infrastructure just at large is one that perhaps needs considerable focus, not just in Bangladesh, perhaps, but in a much wider context, so that we can actually improve credit histories, enable better risk assessments, and strengthen just the larger sort of ecosystem for women-led climate MSMEs. So let me maybe just close with this, that it doesn't seem to be about something overly complex. It's really coming down to me in terms of how systems and ecosystems and products are actually designed. So if we can look at, we've heard around examples of how sort of guarantees can shift risk. We've heard about how incubation can build pipeline, how blended finance can sort of unlock private participation. All of these are actually sort of small incremental changes. So I would sort of say that as we continue our work on the sort of collective, we sort of try and focus on these design features in our own institutions and in our own ecosystems that we're actually willing to change. But thank you, Ayako, and I will stop there. Thanks.
Thank you, Karan. I really say thank you again to Karan and also all the distinguished panelists. I also enjoy our discussion today and I learn a lot. And we are looking forward to collaborate more, tackle jointly on this issue. And I think our collective effort can create some difference in the coming future. So we have another webinar next month on the climate risking and climate insurance. So we will send the notification to you all as the date is finalized. So thank you so much all for participating in us, and hope we will see you again.